Welcome back to Yahoo Finance Live, everyone. With markets attempting to price in a mild recession, we spoke with Mohamed El-Erian last week, who had this to say about the global growth projections. Take a listen.
Not just should, we will see growth projections coming down more. We got some pretty awful PMI numbers out of Europe. The three biggest areas in the world are all slowing simultaneously: China, the US, and Europe. And what you're seeing in the oil market, it tells you that demand is now in control. For a long time, supply was in control of the oil market, and that drove prices higher and higher. So now it is demand, and as people worry about a global slowdown, they worry about demand for oil, and oil prices have been coming down.
That was President of Queens College, Cambridge, Mohamed El-Erian, joining us. And for more, let's bring in Keith Lerner, who is the Truist Chief Market Strategist. I want to get your reaction to the commentary from Mohamed, and particularly on the kind of face of some of these global economic slowdowns that we've been tracking, but also some of the projection pullbacks that he's expecting.
Yeah, well, first, Brad, great to be with you and the crew this morning. I think there's no doubt the global economy is slowing down. If you take a step back, we've seen one of the most aggressive global tightening as far as rate hikes from central banks that we've seen over the last decade. And that interest rate increase works with a lag. And we're already starting to see that somewhat, in the overall market. The only, the saving grace, I would say, for, the U.S. markets, as an example, at the lows before last week's rebound, we were down about 24%. The median decline around recessions in the U.S. has been 24%. The average is a bit more, and there's no, we can certainly overshoot that, but at least some of that bad news is reflected in markets today.
Keith, is the reality that the markets can't go on a sustained rally until we get a more pronounced decline in gas prices?
I think it's more about, and it's hand in hand, Brian, I think it's more about inflation. The market really has to feel comfortable that inflation is not only peaking, but going to be coming down at a pretty, aggressive pace. And that way you can see stabilization in valuations. On a year-over-year basis, valuations are down for the S&P about 28%. I mean, that's one of the most aggressive re-ratings we've seen, in the last 30 years. The other side, though, is it's also about earnings. I heard you all talking about that earlier as well. I mean, one positive, Brian, potentially on the earnings story, just to kind of inject that, is that, even though economic growth has been moving down, real economic growth, what's less talked about today is nominal GDP growth for the U.S., which includes inflation, has actually risen from about 8 to about 8.2 since the beginning of the year.
And I guess that has to do with what we've seen with inflation and companies taking advantage of it, perhaps. But Keith, I want to ask about tech in particular, because we had tech lead on the way up, tech lead on the way down. And I'm curious, what now? If and when we get out of this, is it going to be tech that once again sort of comes to the rescue and leads the gains?
Yeah, we've been underweight tech for most of this year. We're still underweight. I will say you're starting to see some signs of stabilization, at least on a relative basis. So we're watching this. I don't know that it's going to be leadership. It's been leadership for the last decade. Often after you go through one of these downturns, what comes out of the downturn, leadership shifts. And I also think, it also depends on how sticky this inflation. Part of the reason why tech outperformed for so long is they had slow economic growth and slowing inflation. If inflation stays somewhat stickier and for a bit longer, then that may not be the best overall backdrop for tech. But again, are there opportunities within there? Sure, and it's something we're watching. But at this point, we're still underweight the sector.
Keith, is this bear market over?
Now, Brian, I don't know that it's over yet. I think there's going to be a difference in the way we come out of this relative to the last decade. If you think about it, the last decade, you had a lot of V-shaped recoveries for the market. And why did we have those V-shaped recoveries? Because the Fed had the markets back. And I think we'll probably go more back to this kind of, you talked about earlier, a bottoming process where you have a move up and then moves back down and retesting, which we didn't really see the last couple of years. But now the Fed is not going to save the market necessarily. So I think we'll see more of that. I think the best you can say right now, Brian, is that we had a very oversold market. We had basically 2% of stocks above their 50-day moving average. That's a very oversold market. You've had a bounce. We think the bounce likely has further to go. But we think that's in the context of a wide, choppy range that's likely to continue. And it's premature to say that the bottom is in.
That's why we ask you these hard questions, Keith, because we know you can answer them. Truist Co-Chief Investment Officer Keith Lerner, always good to see you. Great work as always. We'll talk to you soon.
Appreciate it, guys. Thanks so much.